Welcome back, everyone. Today's explainer dives into a really massive challenge for any growing manufacturing business or machine shop out there, and that's acquiring serious hardware. We're going to be walking through a strategic playbook that basically demystifies equipment acquisition and shows you exactly how to maximize your 2026 tax savings so you can scale your operations efficiently. $425,000. Just let that sink in for a second. Based on recent industry data, that is the typical cost of a single industrial CNC machine for a precision manufacturing setup. I mean, we are talking about a tremendous amount of capital just to get one piece of equipment on the floor. Which leads us directly to the elephant in the room, right? How can your growing business possibly afford to scale, to acquire such expensive, absolutely crucial equipment without completely destroying your working capital and, well, going broke? It's literally the core dilemma every single shop owner faces at some point. Okay, so here's our roadmap for today. We'll quickly cover the cost of growth, the big decision to lease or to buy. We'll explain SBA loans, dive into Section 179 tax savings, and then wrap up with the bonus depreciation boost. Let's jump right in. Section 1, the cost of growth. Now, while these machines require a massive capital outlay, they range anywhere from $50,000 all the way up to $800,000, they are ultimate problem solvers. Think about it. A single CNC operator can run multiple machines at the exact same time. That drastically increases your output and replaces incredibly expensive manual labor. Plus, the data shows us these machines typically have a solid 15-year useful life cycle. So if you utilize them properly, the return on investment is incredibly rapid. It's a real game changer. Section 2, to lease or to buy. All right, moving on to the offense of our playbook, the absolutely crucial point here is understanding the fundamental trade-offs. If you buy a CNC machine, you build long-term equity. It belongs to your business, and it unlocks major tax depreciation benefits. But, it requires a much higher initial capital hit. Leasing, on the flip side, acts a lot like a long-term rental. It preserves your short-term cash flow with lower upfront costs and gives you the agility to regularly upgrade to the newest tech. But the catch? You build zero equity. The choice entirely depends on whether you're optimizing for long-term asset wealth or short-term operational cash flow. But hey, what if you want the best of both worlds? Enter the Equipment Finance Agreement, or EFA. This is a brilliant hybrid option. It's essentially a flexible loan where the equipment itself serves as the collateral. You get outright ownership from day one, which means, yes, you get the tax benefits, but you don't need a massive standard down payment, and there's no surprise buyout at the end of the term. Win-win, right? Section 3, SBA loans explained. It's actually fascinating how specific needs map to the right loan here. If you're buying a massive piece of equipment, or say real estate, the SBA 504 is designed specifically for you. It offers fixed rates typically in the 6 to 8% range, and importantly, it uses the financed asset itself as collateral. Conversely, the 7A loan is more of a general purpose tool. It's great for working capital or inventory, but it usually carries a variable rate, currently capped between 9 and 13.25%. And get this, it requires you to pledge all available business collateral, so you've really got to choose strategically based on exactly what you're trying to fund. Section 4, Section 179 tax savings. Okay, now for the defense portion of our playbook. $2,560,000. No, that's not a typo. That is the 2026 Section 179 deduction limit. This is an incredible provision that allows a business to deduct the full purchase price of qualifying equipment and software in the exact same tax year it's put into service, rather than slowly stretching that depreciation out over several years. It is a massive upfront advantage. So what actually qualifies for this massive upfront write-off? Well, CNC and heavy manufacturing equipment perfectly fit the bill. So does off-the-shelf software and specialized non-passenger work vehicles. Even certain heavy SUVs qualify, though keep in mind those are capped at a $32,000 deduction. But here's the biggest rule you need to remember. The equipment must be used for business purposes more than 50% of the time. And importantly, both brand new and used equipment are eligible. How cool is that? Actually, hold on, we do have to exercise a little caution here. These benefits are really tailored for small to mid-size operations, so they do have caps. The deduction begins to phase out dollar for dollar once your total equipment purchases for the year exceed $4,090,000. And if you spend over $6.65 million, the Section 179 benefit disappears completely. So you definitely want to plan your acquisitions carefully to stay right in that sweet spot. Section 5, the bonus depreciation boost. All right,
Here is where the strategy gets incredibly powerful. For the 2026 tax year, the bonus depreciation rate has been fully restored to 100% for eligible property. Now, it had been scaling down in previous years, but for 2026, it is back at full strength, 100%.
Let's look at the stacking order to see how this builds, because IRS rules require a very specific chronology if you want to use both codes. Step 1. You take your maximum allowable Section 179 deduction first, up to that $2.56 million limit. Step 2. If there is any remaining cost basis left over on the equipment, you then hit it with that 100% bonus depreciation. Let's put this into a real-world scenario to show you the undeniable power of this 1-2 punch. Imagine you're buying a $3 million equipment package. First, you apply your Section 179 deduction, writing off the maximum $2.56 million. That leaves a remaining balance of $440,000. Next, you apply your 100% bonus depreciation to that remaining $440,000. So your total first-year tax deduction? The entire $3 million. You have effectively written off the whole purchase in year 1. No way, right? It's literally that good. And this brilliantly illustrates why this matters to your bottom line. If your business operates in a 21% corporate tax bracket, being able to deduct that full $3 million results in an actual tangible cash savings of $630,000 in taxes that you no longer owe this year. That means your effective net cost for that $3 million equipment package just dropped to $2.37 million. Guys, this is exactly how smart shops scale. As our source material perfectly summarized, by carefully analyzing cash flow and tax rules, you make a strategic choice that sets your shop up for sustained, profitable growth. Understanding how to really leverage EFAs, SBA loans, and these incredible 2026 tax codes, well, it transforms you from just a passive equipment buyer into a highly active, highly profitable business strategist. So, you've got the playbook. You know the financing structures, you know the tax limits, and you know exactly how to keep your capital safe while scaling up. Now that you know how to fund it, what will your next big investment be? Get out there, strategize, and go make 2026 your most productive year yet. Thanks for joining us.